Good morning, ladies and gentlemen. Well, I have one aim in this video, and that is to explain to you the possibility and the very wide range of outcomes that could happen as a result of the election and the moves in risk parity, which I think are going to be quite extreme. So to start off with, let's just go through what the risk dial is showing, and it fell about nearly 50 points from the upper 70s to 29, which is quite a significant move and is now poised to go one way big time or the other. I think the move after the election is going to be sustained, and it's going to last several days, possibly weeks. And as I said, with a very wide range of outcomes, which I will explain. First of all, let's examine the scores. You can see how throughout the week it has been falling steadily, and we now have a typical reversion to price of the spreads below one of the moving averages, which is the first sign that things might start turning. We had the weekly one fall down. As you can see how much it has fallen, and you can see the moving average reverting, and also on the monthly one you can see how much it's fallen and giving exactly the same signal. That is always a sign that we are in an interregnum, that things could change very, very rapidly indeed. First of all, before we go any further, let's examine why equities are valued up here. The very simple reason is we are here because of multiple expansion only, i.e. there's no one that's going to argue that we are here because we are anticipating better forward earnings, i.e. much higher forward earnings than around 160, 170 for 2021. It's only because of multiple expansion. And multiples depend on bond yields. What do you discount something by depends on the yield that you're discounting it with, much more than it does of where earnings are. So if you're discounting 160 by 20 or 25, the range of outcomes is very different. Even if you now expect 170 earnings, whether you discount it by 20 or 25 is completely different, and it's much more important what you discount it by than what the earnings are. So if bond yields now turn up, multiples will either have to go down or forward earnings need to be expected to grow. That is unlikely to happen in this scenario with second waves of COVID and so on. We have very little transparency about forward earnings. People could take them up or down $10. That really doesn't matter. What matters are these multiples, and we will look now at what is a wide range of outcomes that we could have as a result of the election, not so much on equity expectations of forward earnings, but really on the yield that is going to determine the multiple that you discount everything. And those facts lead us to this chart. You can see that in this period we've had a backup in bond yields. We've gone from a valuation of 22 times forward earnings down to something over 20 times forward earnings. So bond yields are going to be the key. If bond yields back up, we could easily go down towards the 18 times Blue Angel, and that is going to give us a much lower stock market valuation than we are currently at. If bond yields reverse upwards, we will go all the way up to, back up to the highs in 22. But you can see that we are basically now at a key inflection point. Either we go up or we go down brutally, and the range of outcomes is huge. So what I'm going to try to do is give you the levels that we could see in one scenario or the other scenario, because I have no more idea who is going to win on Tuesday than you do, and I have no more idea of what the reaction of the bond yields is going to be. All I can do is prepare myself for what the bond yields could do, and by mathematics get to what the likely level of S&Ps is going to be in either case. So let us try and see what the bond market is telling us. Okay, my key takeaway from last week is that when the stock market fell by, the S&Ps fell almost 200 points, the stock market, the bond market could not get off its arse, and the yield curve kept on steepening all week. People might say that a move of, I don't know, from 67 to 71 basis points in 2 stands is not significant, but it's significant when it starts to happen in a period of extreme stock market weakness. That means there is absolutely no money going from into bonds. That money is just coming out of equities, and everything is deflating, i.e. there is no place to hide. There is no appreciation in anything. So to me, we're getting to very important levels. This 75 basis points, we've never closed above it. If we start closing above 75 basis points, that is very, very significant. And if we look at what happens when we close above 75 points, well, then we start spiking all the way up over 100. Okay, so we start going to 100, 25 basis points of movement in the 2s, 10s when we spike above 75. That is very significant, and that gives us a big move in bonds, in the big longer duration bonds. If that happens in the longer duration bonds, that is going to kill tech stocks. If tech stocks get killed, the whole of the S&Ps comes down because of the multiple compression, and basically it's a cascade. So to me, this 75 point level is going to be very, very important, and is going to give us clues as to what the longer end of the bond market is going to do, and in turn that is going to tell us how potentially far the stock market could go. That steepening, which is reflected in 2s, 10s, continues in 5s, 10s, which have now done are at their steepest level in a long time. It is not yet reflected fully in the 5s, 30s, which have not made a new low, but you know my thinking. If 5s, 30s get to 140, that is going to be the key test on the dailies, weeklies, monthlies, any kind of period you can think of. And conversely, if the yield curve starts flattening through 105, 109, that is going to be very, very important as a signal. To me, the path of least resistance is still towards a steepening, and it is also the logical one. If we get more steepening down towards 140, that is going to have a profound effect on multiples. If we go through 140, all hell is going to be unleashed. I hope it doesn't happen, but 140 is the level that is going to be the real test in the yield curve 5s, 30s. Okay, what does that translate to in absolute yield term prices? Last week I told you that we could easily go up and test this 162.05. The high was in TLT was what, 161.5. We got quite close to it and then we reversed. That to me is the key takeaway from last week, that bond yields would not take would not take the opportunity to go up as equities were going down, but that they were sold. That is, I think, significant. As I said, no place to hide. And that shows me that the market's thinking is the following. It doesn't really matter who wins. There's a huge stimulus coming. Whoever wins, the funding requirements are going to be huge, and we're going to steepen the curve in either case. Now, if we start heading down towards this 148.90 level, which is so important, my argument then is going to be that we will get multiple compression in the stock market, and that Druckenmiller is absolutely right. The thing that kills stocks is bonds. Nothing else can kill stocks apart from bonds. And bonds are going to kill stocks if the market starts going down to 148.90 in the TLT. That is going to give us our 140 on the 530s. That is probably going to give us two stands above 75, and could be argued that it's some kind of an ABC flat down, whatever you like to call it in early weight terms, completely unimportant. The level is important, 148.90. That to me is going to be the level where the stock market is likely to stop going down. And let's examine what that level could be, depending on the various outcomes. This is the chart that I'll be watching most closely throughout the election and afterwards. I thought over government, high equities over government bonds. As you will remember, this is where we went into the election in 2016, and we made a new high within a couple of days, and then the trend kept on going for months. And people could not understand why equities were being bid. It was obvious. It was because government bonds were allowing them to do so. And money was flowing out of govies and into equities, but that was not so much a multiple expansion as real forward earnings because of the tax cuts, and the economy was growing and the growth was accelerating. Nobody will say that that is the situation now. The economy is not accelerating. It could accelerate in expectation of a vaccine and afterwards, but I don't think that is really what the market is focusing at the moment. What the market is focusing is what range it should be trading at the moment. Should it be this upper range, or should it be this medium range down here? You can see what happened in February. We came down into this area, hang around for a bit. There was no help for the Fed, and the market just went down and then came all the way back up as soon as the Fed started intervening and doing QE. Why did it come all the way back? It came all the way back because of multiple expansion. As I told you at the beginning, this is all multiple expansion because the bond market was doing well, risk parity could do well, and therefore equities rallied. Now, if this turns around and we start going back down towards this level, this opens up a huge range of much lower prices in the S&Ps, because if bonds are reversing, then equities will reverse with them. And down here, if you do the math, it'll give you levels below 3,000. The spreads that I consider that will lead me to the right conclusion about what to do are these. Basically, tech is now beginning to underperform everything. This is one of the very, very rare times that XLF is outperforming XLK, and it's now making new highs on the move. XLV over XLK, as you can see, that is also making a higher low, and the trend seems to be higher. XLI over XLK, even the poor XLI sector is outperforming or very much keeping its pace with XLK. QQQ over IWM rolling over. NDX over SPY rolling over. QQQ over SPY seems to be rolling over. Now, I think that if the bonds start breaking down as a result of the election, and let's say it's a blue wave, you will see a massive spike, possibly all the way down to those levels that I just spoke about in TLT, and that is really going to break the back of the tech sector, which has the longest duration. And if that breaks the back of the spreads in the tech sector, that is going to drag everything down with it, because as we know, 99% of the performance in SPY is actually a few tech stocks, and if they get broken down, the move is going to be quite massive. Okay, I hope that I've been able to explain my thinking about how the bonds are going to influence the multiples, and what does that translate to in absolute term price in the SPX. Well, if the bonds do spike, and we see that level below 150 in the TLT, and the curve goes massively steeper, what that implies to me is, given the level of the chart of the equities against the bonds, we are likely to see this area here. And so basically, for people who've been following me for a long time, they know that I think that the most important level is 28.64, but the one after that is 29.54. Quite possible that we have a multi-day cascade taking us all the way down to these very important 29.54, 28.64 levels, which people will remember how well we did when we bought it here at 28.64 and rode it all the way back up for at least a couple of hundred points. I think that could very well be repeated, very, very easily repeated, if we get the bond prices that the TLT chart implies. If we get down to 150, I think we fill this gap here that we have on the dailies, and basically we trade between 29.54 and 28.64. Equities will follow the price of bonds. It's a complete misnomer to think that the two will diverge. They would diverge if people thought the economy is going to grow. Okay, that is undoubtable. But we are not in a period when the economy is growing. We are in a period where you are just discounting a certain level of earnings by a denominator which is determined by the bond market. If the bond market goes up in yield, that denominator has to deflate the multiples in the equities, and therefore we get lower prices. It doesn't take a genius to understand that. You will not. The bond market and the equity market are now married at the hip until we get a vaccine, or the expectations of a vaccine, and people can see real growth taking place in the economy, and therefore forward earnings can expand. And that will be a healthy development, but I think we're several months away from that. I think the likelihood of bonds and equities diverging in the next 2 or 3 months is very low, or until a vaccine is announced. Volatility is showing the possibilities. That is all it's doing. People are getting worried. That bond move last week was very, very worrying. That is why I just couldn't get long for a bounce in equities. We've got a bit of a bounce here and there, 100 points in NQ, 20, 30 points in the S&Ps. To me, that's just not worth playing, because you could get buried by 200 points in S&Ps to try and make 30 and with the possibility of losing 200. You know, it's not what I want to play. We haven't crossed over the really important 43, closed above, closed the week above 43, but we are getting quite close. But what we have done is closed in the in the Nasdaq volatility above the 40 level, okay, which is very important. It's giving us the possibility of really wide moves in volatility either way. We could very quickly get into the 50s, 60s, 70s, 80s in Nasdaq volatility. It could very easily happen. All we need is the bonds to go limit down on a blue wave. The Democrats controlling everything, every apparatus in the country, i.e. the Senate, the presidency, the House, and we are going to have massive moves in volatility upwards and very large moves, especially in NQ. I mean, NQ can't help it. If bonds go up in yield, NQ is going to get destroyed because it has the highest duration. Well, here we have a monthly chart of NQ, and I don't think there's any point in looking at shorter time frames than monthly and weekly. You can see that we could easily see a 0.382 retracement of this whole move, couldn't we? 10,200 odd. Even in 9,600, around the 50% retracement in the previous highs shouldn't really shock us, should it? And if we really now start looking at the weeklies, the first level is here, 10,200-ish, where we had all these previous lows in, what was this, in July. So why should it shock us that we do a quick ABC and go back to where we were in July? Really, we are likely to go to this kind of 9,700 level, because that really is where we were trading, where bonds were trading back from where they are now. The situation in the economy has not improved. If we were to test this moving average and this lower Bollinger Band area around 9,800, 9,600, why should that shock anybody? And how is that bad in the long term? How have we collapsed? How have we died? We haven't. All we've done is reacted to the move in the bond yields, and we are probably in a very nice bounce area, longer term. So what? If we come down to 9,700, what is that? That's a 12% move, something like that from here. That is not the end of the world in technology. But if technology comes off, double digits, that is almost going to be reflected. Actually, it's not going to be 10, 12, it's going to be 7, 8% in the S&Ps. And that gives us that level just below 3,000, around the 2954 or 2864 that I consider so important. So as you can see, those levels are by no means out of range. Where to hide? That's the question. Well, I guess the two sectors which are outperforming, if you could call it that, sorry, not sectors, but two markets which are outperforming, are actually EEM and Japan, which makes sense, simply because you have the least kind of exposure in those markets to the bond yields that are happening, bond yield moves in the States. But it's, they're just going to fall less if the worst happens. And you can see how SPY over EWJ, so basically the S&Ps over Japan, is coming in. It wouldn't surprise me if it came into around this 520 area. and SPY over EWG, i.e. Germany has already reached these overbought levels. If it started falling back a bit, that would be normal. This is over FEZ, which is Europe. If that came back a little bit, and you can see EWG, so Germany over Japan, how much Germany has fallen relative to Japan, because Japan is seen as more of a safe haven and it doesn't have the COVID situation and so on. So to me, that Japan is a better bet on the to fall less if the market starts falling in the States because of the bond yields. I don't know if the bond yields are going to spike. I don't know, but I'm saying I'm prepared. If they do, I take my money out of the US and I put some into Japan, and mostly in cash. Japan is only going to fall less. It's not going to go up, I don't think. And here we have the relative spreads of EM against various markets. As you can see, EM is absolutely stable against Japan, but it has begun spiking against Germany, and it's beginning to make new highs against the States. I am very conscious that EM is actually very dependent on the dollar, and the dollar could start going against EM and therefore smack it back down. But I just get the feeling, the gut feeling, that that EM is going to continue to outperform, which tells me really that the dollar is unlikely to move that much, which makes sense, because if we start having, although we are having higher relative yields in the US compared to, let's say, Germany, we also are, if we get a massive stimulus, we're going to get printing of dollars, and the printing of dollars is inflationary, and also means there are more dollars about, which could suppress the price of the dollar, in which case EM is going to be one of the main beneficiaries. And it really wouldn't surprise me to see EM trade at levels last seen in 2016, 2017, which is going to give us a much better relative performance in EM than in the States. So let us look at the dollar and gold and see if that is giving us any clues. I don't think the situation in the Dixie has changed at all. It keeps on holding on by its fingernails to this trend line, which, although I don't like trend lines, it's beginning to look more and more important. To me, the level is still 96.62. I think a weekly close through there now, and this goose is cooked. It's going down towards this 88 level. That is my preferred logic. Could it do an ABC up initially? Absolutely. But I think this level around here between 95 and 96 is going to be 95.50, and love to see it up here at 96 odd. I think the risk reward there via options is just overwhelming. I think the logic here has not changed. I think we see a massive stimulus, whoever gets elected, and therefore the massive stimulus leads to printing. I don't think it leads to growth in the States. I think it just leads to printing. I think it leads to a little bit of inflation at some stage, and if that happens, I think they're going to sell the dollar. That's just my thoughts. When will I be wrong? I'll be wrong if it starts powering through this 96.47 area. If it starts going through 96.47, I'm massively wrong. But just like I knew up here when I was wrong in inverted commas that Donald Trump wanted a lower dollar, and finally we got it. I think it could easily go up there, because as a first reaction, let's say bonds spike, the yield differentials go out even further between Europe and the States. If that happens, the first reaction could be the dollar goes up. But I think at this 96 level, buying 3 to 6 month puts on the dollar, I think it's going to be very rewarding eventually. I was very impressed by gold, which is just a second derivative of a combination of the US dollar and bond yields, real bond yields. How it just did not want to go up at all last week, and eventually it was right. Bond yields went up and gold fell. Now, if I think that bond yields are going to go up over the course of the next 2 or 3 weeks and quite substantially, and I don't think the US dollar is going to do very much, or if the first reaction is to rally, I can't be bullish of gold and I can't be buying it again at 1860. But I have to be buying it at lower levels. I don't think 1810 will hold the move in the bonds, but I do think the 1760 level is beginning to look very attractive. 1760, 1750 is the level that I think gold could possibly get to if we get this move in bonds. It's going to be a great level to buy because I think the Fed eventually stabilizes bonds and hence equities, and I think the money printing that is going to happen through the massive levels of support they're going to finally pass is eventually has to be bad for the US dollar, and that has actually got to be good for gold. So I will be a big buyer of gold at this 1760 level. And here you have the relative performance of TLT against gold. People who have followed me for a long time know that I consider this line to be very, very important, and I think that over the course of the next weeks you will see this rolling over and going back down towards this 79 level, which is a 10% move. I think that probably to me means is that TLT goes down in price, gold goes down with it, and then gold bounces. And as the gold bounces and TLT stays roughly balanced towards higher yields, that favors gold in a big way as the US dollar comes off, as I've explained a little bit earlier. So if this chart tells me to be biased in favor of gold and against bonds, and while the other chart, the SPY against gold, is very neutral, that tells me that bonds could be the worst performers, followed by equities, followed by gold, i.e. gold eventually favored over the other. What does all this mean for next week? Well, it's going to be difficult, isn't it? You see the wide range of outcomes and the huge moves that this could, very reasonably produce. And the clues are going to be here. If we go to 140, I think everything that I've said is going to come true very, very quickly. On the other hand, if we go through 75 and to 140, I think it's going to be very, very difficult to hold in the S&Ps until we get 3155 is the first level, but that's not going to hold it. There's really nothing until 3027, 2954, and then 2864. These are the important levels. I think we might even get to 2954 and bounce 200. That is the kind of level that you will be looking to pick it up at. The NQ is going to suffer most if we get the steepening, and really you're looking to pick him up around this 9,750, between this 10,150, 300 down to 9,750 as I showed you. That is the area. I think that's going to be a wonderful, wonderful gift And we will think of some option strategies as of Monday to take advantage of that. The EM is outperforming. If we've had a fantastic ride in Bobble, haven't we? Just a fantastic ride. Now, 135.70 gives us loss of impulsion. Loss of impulsion is going to be very important because we are trading at minus 70 something, right? Why are people buying Bobble? Because they don't want to own DAX, they don't want to own equities, they don't want to own duration as much. So they're buying Bobble and looking for appreciation from the Bobble. If they think they're no longer going to get appreciation from the Bobble, who wants to own something which is depreciating and has a negative yield? I mean, no one in their right mind. So as soon as you get loss of impulsion, you get a big move the other way. My stop is 135.70. I think I will see it. I have lightened up quite a bit. I've realized a lot of gains below 135.70, and I think that is another confirmation that bond yields are going to back up significantly, and if they do, watch out in equities because they're just not going to be able to stay up. It's going to be a very exciting week. I hope to be with you every step of the way, and let's make lots of money next week. Thank you.